You borrow $40,000 to invest in your future. 20 years later, you've paid back $65,000, and you still owe $38,000. That's not a horror story. That's just how income-driven repayment plans work when the math doesn't add up. My name is Dave, and I spend way too much time thinking about why we treat debt like a neutral financial tool when it's actually a bet against your future income. This one's for anyone who's been told student loans are good debt or that monthly payments are all that matter. If watching this saves you from a decade of confusion, there's probably more here that'll click for you too. Here's what sounds completely reasonable. You take out loans for college because education increases your earning potential. You pick an income-driven plan because the payments are affordable. You focus on your career. You make your payments on time. You're doing everything right. That belief persists because it's wrapped in optimism. College is an investment. Investments pay off. And income-driven plans were literally designed by the government to help people, so they must be helpful. The whole system feels protective. But let's look at what actually happens with money. Say you borrow $40,000 at 6% interest. Your income-driven payment is $150 a month because you're earning $35,000 right out of school. That feels manageable. But here's the part they don't highlight. At 6%, your loan generates $200 in interest every month. You're paying $150. So every single month, you go $50 deeper into debt. Your balance isn't shrinking. It's growing. After 1 year of perfect payments, you don't owe $40,000 anymore. You owe $40,600. People see the affordable payment and think they're making progress. They're not. They're renting their debt. Let me show you a different shape of the same problem. You stay on that income-driven plan for 10 years. Your income grows. Let's say you're making $50,000 now, so your payment increases to $280 a month. You've made 120 payments. You sent the loan servicer over $25,000. And your balance? It's now $48,000. You've paid for more than half of the original loan amount, and you owe more than you started with. This is the compound interest game in reverse. Normally, compound interest works for you when you invest. Here, it works against you. The unpaid interest doesn't just sit there, it capitalizes. It gets added to the principal. Now you're paying interest on interest. It's like trying to walk up a downward escalator that's moving faster than you are. I want to tell you about someone I'll call Sarah. She graduated with $55,000 in loans, got a job in nonprofit work making $38,000, and immediately enrolled in an income-driven plan. She wasn't avoiding responsibility. She was following the exact advice her loan servicer gave her. Her payment was $180 a month. Affordable, predictable, safe. She made every payment for 8 years. Then one day, she logged into her account to check her balance, expecting to see it under $40,000. It was $62,000. She called the servicer, thinking it was a mistake. It wasn't. They explained capitalization. They explained unpaid interest. They explained that she'd been accruing roughly $275 a month in interest while paying $180. She asked what she should do. They said, keep making your payments. Sarah wasn't irresponsible. She was trapped by a system that made the trap look like a solution. Now, maybe you're thinking, but what else was she supposed to do? She couldn't afford a higher payment. That's the real tension. Income-driven plans aren't evil. For some people, they prevent default, and default is worse. But the issue is that they're sold as a strategy when they're really just a delay. The loan doesn't go away. The interest doesn't stop. And unless your income grows fast enough to outpace the accrual, you're just postponing a problem that's getting bigger. The better question isn't whether the payment is affordable. It's whether the loan itself makes sense in the first place. And if you already have the loan, the question becomes, what's the actual cost of this affordable plan over 20 years? Here's the pattern worth recognizing. This isn't unique to student loans. Anytime you're offered a lower monthly payment in exchange for a longer timeline, you're being offered the same trade. Car loans, furniture financing, buy now, pay later plans, mortgages with extended terms. The pitch is always about the monthly number, never the total cost. It's not that monthly payments don't matter. They do. But when a monthly payment is low because the timeline is long and the interest keeps running, you're not buying freedom. You're buying the feeling of freedom while staying locked in. The trap isn't the loan. It's the structure that makes you feel like you're managing it when the math says otherwise. So here's some questions worth asking yourself, whether you're considering loans or already in them. What's the total amount I'll pay over the life of this loan, not just per month? How much interest am I accruing compared to what I'm actually paying? If my balance is growing instead of shrinking, what's my actual exit plan? Am I on this plan because it's the best financial move or because it's the only one that feels possible right now? And if my income does grow, will I adjust my payments or will I let lifestyle inflation eat the difference? These aren't gotcha questions. They're just the questions the system doesn't ask you to think about. Here's the reframe. A monthly payment you can afford isn't the same thing as a loan you can afford. One measures cash flow, the other measures total cost. And confusing the two is how people end up paying for decades. Let me pull this together. Student loans aren't automatically bad, and income-driven plans aren't automatically traps. But when your payment doesn't cover your interest, you're not climbing out. You're treading water in a pool that's slowly filling up. The loans were supposed to be a bridge to a better financial life. But if the interest outpaces your payment, that bridge just keeps getting longer. You're moving, but you're not getting closer to the other side. The system isn't designed to trick you, but it is designed to keep you paying. And the difference between those two things matters. If this didn't land for you, but you know someone staring at a loan statement wondering why the number won't go down, maybe send it their way. Sometimes it's just easier to see the math when someone else walks through it. And if you've ever wondered why credit cards feel even harder to escape than student loans, it's the same pattern, just faster. What makes minimum payments so dangerous when the interest rate is higher?